Interest rates. That's a common question that a lot of people ask me. They say, what are the rates going for rent roll purchases? Now, it's a really difficult question to answer. The reason for that is that banks will generally price for risk. What that means is the higher the risk, the higher the interest rate that you'll pay. And conversely, the lower the risk, the lower the interest rate you'll pay. So a lot of it's aligned to customer risk scoring behind the scenes. Little things that have an impact on interest rates will be the LVR, or loan to value ratio, also how much experience you've got in the industry, but also how risk-friendly the transaction is. So what I mean by that is if the cash flow of the business is really, really strong and you've got a strong amortisation to pay back the loan, then lower the risk and therefore lower the rate. But just as a broad line figure, you're sort of looking around about the 6% or thereabouts, depending upon funding amount. Once again, the higher the loan, typically will attract a lower rate because the banks are getting more money, so to speak, and the lower, smaller sized loans will be generally a higher rate, so they can meet their internal return on equity and return on investment requirements for their pricing matrix. Also, the security has a play as well. If it's secured by real property, you'll generally pay lower interest. If it's purely a cash flow lend, meaning being secured against the rent roll itself, it'll attract a higher rate as well.